First of all, I want to say welcome to the CitaDAO and BanklessDAO AMA. I've been super excited to have this happen for the past couple of weeks. We've been really looking forward to it. I want to start by saying we are not financial advisors. None of what we're about to discuss is financial advice. Investing in crypto and DeFi is risky. And although we're excited to share this information with you, please do your own research. So with that, I want to introduce CitaDAO as a real estate tokenization platform that's bridging real-world assets with the blockchain. By introducing real estate on-chain, which is also known as IRO, the CitaDAO team aims to help real estate investors unlock capital while also accelerating the adoption of Web3. This fits with the Bankless mission of bringing 1 billion people on-chain, and that is exactly why we've invited them here today to talk about their project. So today we have Joel and Ethan with us. They're going to be giving us an overview of the project, and then we'll open it up to some questions at the end. So Joel is a contributor at CitaDAO. He's been involved in the real estate industry since 2011. Prior to CitaDAO, he was with UBS Investment Bank, CBRE, and Capital Land. And Ethan runs community growth at CitaDAO, and he's an active contributor here in the BanklessDAO Marketing Guild. I'm sure you've seen him around if you've had anything to do with marketing, the Instagram feeds we've got going on. He's been doing a lot of great work there. So with those introductions out of the way, I'd now like to hand it over to Joel to explain a bit more about CitaDAO. Take it away, Joel.
Thank you, NF Tinker and GM, everyone. Very excited to be here at the BanklessDAO community to have this opportunity to share with everyone the CitaDAO project. So probably a little bit more about myself before I go into detail, and really the genesis of how the CitaDAO project was came about. My personal crypto journey kind of began back in 2017 when STO was all the hype, and back then I was with an institutional landlord. And being on the landlord side, obviously, if you're going to tokenize a property, you need the real estate to begin with. So we received many real estate tokenization projects that kind of came to us to request a collab opportunity to inject our properties into their project to help tokenize real estate. But there were two very important questions that we could never get a good answer then. The first one being how we could legitimately enforce our rights, legal rights, to redeem the real estate token for the underlying real estate, which means that if I go to SPV holding to real estate and I want to redeem the title deed, I need to be able to enforce my rights in court if need to, right? And get recognized for it. So none of them could really give us a good answer for that. And the second one, which is even more important, was how we could actually exchange the real estate tokens for liquidity in the secondary market if I do not want to redeem the title deed. Again, no answer for that. But it actually got me and a few institutional lawyers started together. We brainstormed on a legal structure that will legitimately confer the right to redeem the real estate with a real estate token, just like how you can redeem the US dollar with USDC. And it was kind of back in October 2020 that we had a breakthrough, and we were able to come up with a structure, a legal structure that prestigious law firm with more than 100 years of experience specializing in real estate law is willing to officially issue a legal opinion to validate the legitimacy of the structure. With a family office supporting us with their real estate, we kind of reached out to members of the DeFi community to invite them to build a DAO together. And the response was overwhelming and very supportive, with a number of founders joining us on this journey. So today it is a little bit more than 1 year since the genesis of the CitaDAO project. We have come a long way, and we are very excited to share with you, the BanklessDAO community, our journey to introduce real estate on Web 3.0, to bring real estate on chain, and in the process to bring us one step closer towards bringing 1 billion users to the DeFi ecosystem. We are building an ecosystem of sustainable DeFi yield farms powered by real estate globally. And our project is CitaDAO. So that is kind of like a brief overview about the genesis of our project and my experience in the crypto space. So if there's no other question, I'll probably go further into how our project kind of achieved those goals.
Yeah, definitely. Get as deep as you want because we want to hear all the juicy details.
Okay, cool. So okay, so next, right? Why real estate tokens? Why is 2022 going to be a year for real estate tokens? One word: inflation. We believe inflation is here to stay, and that's a result of very it is a result of very poor, my personal opinion, okay, very poor judgment by governments all over the world to just print fiat currency. I felt that it is very irresponsible. Which we can see the outcome of the pandemic. The rich got richer, and the poor just got even poorer, literally. And we believe that this is very irresponsible behavior. In the real world, what happens is that most people, typically the wealthy, they are able to hedge against inflation by aping into real estate. But for the majority of the rest of us, it's kind of out of reach. And even within the DeFi community, for those who have seen their portfolio gone from 6 digits to 9 digits or even 10 digits, right? If you look at a typical crypto native portfolio, there's only two options available. One is your native tokens, which are highly volatile. In good times, it can go up a lot. In bad times, as we can see, it can go down a lot too. Or stable coins if you don't want volatility. But with stable coins, you're subjected to the irresponsible behavior of the money printers, and your purchasing power naturally get eroded over time. We believe there's a third asset class that's lacking on chain. We believe that asset class is real estate tokens. The ability to aid into an inflation hedge without sacrificing volatility. That is what we'll be introducing. And we have seen also the space in the DeFi space grow exponentially, especially in DeFi summer, especially across 2021, TVL exceeding over 250 billion, most of which we see chasing high yields in projects. But we believe that these high yields are actually unsustainable, and most of them have started to decline and revert to mean, especially for the more quality, productive projects on chain, as more and more money chase an increasing sparse supply of them. Our belief here is that real estate, with its own rental yield, can actually meet this demand that we see so increasingly important in this space. So that's kind of some of our thesis as to why we believe real estate itself as an asset class, real estate tokens, will be a very important thematic topic in 2022, with inflation overhanging in the background. Above and beyond that, with increasing regulatory scrutiny over stable coins, we believe for those who are true supporters of DeFi decentralization, that real estate tokens offer stronger stability and yield than stable coins, simply because they are fully decentralized, not centralized in bank account. Each real estate token represents a right to claim against that specific real estate located somewhere in the world, and they're spread all over the world, spread all over the countries. It's not like your stable coins where they're backed by US dollar that is kind of centralized at bank accounts. And if those bank accounts are ultimately seized or frozen or confiscated, the reserve backing the stablecoin is no longer there compared to real estate, right? Most importantly, we believe that real estate tokens, they are transparent 100% of the time. And this is important because this lends greater legitimacy to these tokens to be enhanced, collateralized, and leveraged to generate even better rewards for the holders. And what do I mean by that? So imagine you have maybe a stablecoin protocol that comes around and say that, hey, I'm back 1-to-1 with US dollar, and I'm audited every month, or I'm audited every quarter to show that that money is the bank account. What's there stopping anyone from actually borrowing those dollars to put in a bank account for the audit and to return them thereafter after the audit's over, right? Nothing, right? For real estate, you can't do the same thing. You can't borrow a title deed and return the title deed. The real estate claim against the real estate token claim against the title deed is immutable, is whole, and because of that, it is a lot more transparent. If the real estate is there, it's there. If it isn't there, it's not there, right? You can't just lend and borrow it. So our platform CitaDAO, we will leverage DeFi to drive demand and unlock capital efficiency in real estate. We believe that today's real estate lacks access, liquidity, and composability. It is a very huge market, more than 280 trillion. And a whole bunch of that capital is locked. Money that is not doing anything, not earning interest, not being invested, not being used to drive the economy, not used to improve the gap between the have and the have not. And you think about it, today, if you have $1 million in cash, and you put that $1 million in cash in a bank, fixed deposit, right? Not the best use, but let's say for the sake of this illustration, you put that $1 million in cash in the bank, fixed deposit. You're still going to get some form of interest that the bank is going to pay you for depositing that $1 million in cash with them. But now take this $1 million, put it into real estate. You buy a piece of property. You get a title deed that's worth $1 million because you paid $1 million for the property. Now try taking that title deed, go to the bank and say, hey, I want to put this title deed in a fixed deposit account and I want you to pay interest on that for me. They're not going to give you any interest. This $1 million you put into the property is locked. With DeFi, we can unlock that capital. With improved accessibility, liquidity, and composability. And we believe this will drive demand for real estate on chain to not only increase the capital efficiency, but enhance the overall fair value of the real estate universe. In fact, in future, we believe that there will be two sets of prices for real estate. The price of real estate on chain and the price of real estate off chain. And we believe that the real estate on chain will always have a higher value than real estate off chain, simply because there will be more use cases for the real estate tokens on chain with the composability of the DeFi space. Unlike the limited use cases for real estate off chain today, that is constrained by existing limitations on how we can unlock that capital in real estate, mostly determined by the banks or the governments of the world. Now, to give you a simple analogy here, imagine you have an iPhone, and the iPhone only have 3 use cases. You can only use the iPhone to make a phone call, to send a SMS, text message, or to take a photo with the onboard camera, the inbuilt camera. But you can't share the photo with anyone without sharing with them the phone. How much do you think the iPhone will be worth? Such a phone exists more than a decade ago. and those phones cost no more than $200. But what changed? It is the introduction of the App Store. The App Store acts as a magnet to bring all the best developers globally to the Apple ecosystem to build apps. And what the apps did, the apps increased the use cases for the iPhone. Today, with your iPhone, with the App Store, with the apps, you can play games, watch a movie, go on social media, trade crypto, trade equity, stocks, whatever. You can do a whole bunch of use cases with your phone. That is the composability of the Apple ecosystem. And today, with the increased use cases, even though your iPhone is more than $1,000, nobody bet an eyelid paying for it. This iPhone with the App Store is the real estate tokens. By leveraging the DeFi, which is effectively the App Store, we will be able to bring more use cases for the real estate tokens on chain, increasingly the demand for it. And as a result of that, increase the value of real estate on chain. In future, we believe that the value of real estate tokens on chain will increasingly be driven by the use cases for the real estate tokens itself, with the underlying real estate contributing only a fraction of the actual value of the real estate token. We believe that real estate today is a very traditional asset class that is ripe for disruption. And our team, we have the ability to do it. We believe the time for disruption is now. All assets will ultimately be tokenized in the new world, just like how everything is securitized today. The technology is available today, and there's sufficient liquidity on chain. The remaining limitations to bridge the real estate space with the blockchain really is in the regulatory hurdle and the liquidity hurdle, both of which the team at CitaDAO have the solution to. In fact, our platform will enable a two-way permissionless tokenization bridge for real estate. The CitaDAO platform will allow landlords to independently lease their real estate after ownership verification. The DeFi community will then be invited to commit their interest in fractions of the real estate through a process called the IRO, known as Introducing Real Estate on Chain. And if this IRO is successful, a bridge will be formed, NFT representing the economic legal benefits to the real estate will be minted and custodied in a smart contract. The fractions of the smart contract, ERC20 tokens, will then be deposited into the buyer's wallet. These ERC20 tokens are your real estate tokens, and they will be tradable on the AMM 24 hours a day, 7 days a week, 365 days a year. You get instant liquidity for your real estate. And in the unlikely scenario that anyone wants to delist the real estate, and this is something that we believe we are the only project to introduce, to have the solution to. We have this thing called a Buyout Module, where a real estate token holder can buy out all other real estate token holders and redeem the underlying real estate. This is very important because not only does this legitimize your real estate tokens, now you could redeem the title deed with your real estate tokens. And because of this relationship, it acts as a floor to the on-chain value of your real estate tokens. Because if the on-chain value of your real estate tokens is ever lower than the value of the property in real life, anyone will be incentivized to buy out the real estate tokens, redeem the title deed, and transact it in the off-chain space for profit. This basically sums up our confidence in creating higher value on chain with better accessibility, liquidity, and composability. And we have received a legal opinion from a respected law firm that the structure is legally enforceable And as cherry topping on top of the cake, both the real estate token and the CitaDAO token, they do not constitute a security token. They are not capital market product, and because of that, they will not be regulated. And this is the final thing we need to unlock liquidity. Because as unregulated tokens, because they are not under regulation, the ability to list these tokens on exchanges globally just became a reality. As all of us have seen in this space, the moment a token goes on an exchange, liquidity just exploded. For the first time, by merging DeFi with real estate, we are going to solve something that the real estate tokenization or the security tokenization projects have never been able to done over the last couple of years, to introduce liquidity for traditionally illiquid asset class. And our process to introduce real estate on-chain is going to be very familiar to all of you here at BanklessDAO. It is unique, and we believe will be very rewarding for the community, especially for those who committed early to the IRO. Because, well, let me just share with you how it works. Assuming we have a US 20 million property, which is the case here, and the landlord decides to put up a $1 million commission, in this case, a 1 million reward, to be shared by all participants upon the successful completion of the IRO. The landlord sets the IRO to last over 10 days. Now, even with this, you realize that we have basically this intermediate, the real estate agents. Real estate agents in the past typically collect commissions to introduce buyers and sellers. And they don't have a vested interest in the project. They don't put the money, their money, where the mouth is. In this case, the commission will be shared by those who put the money where their mouth is. You have to be a participant of the IRO to get a part of this $1 million reward. The 1 million reward will then be distributed into reward pools over the next 10 days to reward participants who committed to the IRO for that day. So in this case, we assume an equal distribution of the reward over 10 days. The reward pool for each day is therefore 100,000 per day. The participants will be able to share in this reward pool on a pro rata basis that is determined by their contribution to the IRO commitment pool for that day. So, assuming we have 3 participants who committed to the IRO, we have the first one, let's call her Alice. She committed 10,000 on day 1. Bob committed 990,000 on day 3. Carol committed 19 million on day 5 to close the IRO successfully. Because Alice participated early, she came in on the first day, and she gets in on all the 10 pools, because that's 10 days. And let's assume that the first 2 days, nobody else besides Alice decided to commit to the IRO. Her 10K commitment for the first and second day give her 100% of the pot for the first and second day. And since each day the pot is 100K, her 10K netted her a total of 202,000 in USDC. It is USDC we are talking about here, that she can claim immediately upon the close of the IRO, giving her an instant APY of 73,840%. Bob, who is lower, participated in only 8 pools. He came in, maybe let's assume he came in on day 3. His 990,000 still netted him a decent 228,000 USDC. And he walks away with an impressive 1,050% APY. Carol, she joined late and only participated in 6 pools. Nonetheless, her 19 million, which she used to close up the IRO successfully, netted her 570,000 in USDC that she can collect, earning her a decent 183% APY in return. So as you can see here, Our IRO is designed as yield farms, and they are equally competitive, if not more attractive than most yield farms out there. In fact, as our IRO is backed by tangible quality real estate, anyone can participate with a peace of mind whenever you commit to a CitaDAO IRO. And if it fails, it's very simple. You interact with the smart contract via the UI we set up, and you claim back your commitment. If you put in, Alice put in 10,000, she claims back 10,000 less gas fees. Bob put in 990,000, he claims back 990,000 less gas fees. And Carol put in 19 million, she claims back 19 million less gas fees. So obviously, if you don't claim when the gas fees are high, not going to be materially issue. But what if it's successful? Now, if it's successful, all the commitment, the 10,000, 990,000, 19 million, effectively be converted into real estate token. And now you have a share, you have the right to claim the title deed of the underlying real estate. And what do you do with these real estate tokens? Well, you have two choices. If you're a short-term holder, you're in there just for the USDC reward. You sell it, right, on the AMM and get cash. But if you believe in the project and you want to get the CitaDAO token, only way to get a CitaDAO token, besides buying off the secondary market, is to LP with the real estate token. You can only LP with the real estate tokens. You take the USDC reward that you collected from the IRO, pair it together with the real estate tokens that you have, equal proportion, I'm sure all of you know, and you put it into a liquidity pool to earn a floor of 20% APY in CitaDAO tokens. We are simultaneously also discussing the prospect of collateralized real estate tokens, effectively introducing mortgages on chain. With some of the protocols out there, we are looking at the likes of Abracadabra Money, the likes of Very Capital, so on and so forth, that we have spoken with and have explored this prospect with. And the idea behind it is simple, right? If you do not want to lock up your USDC real estate token and you do not want to sell it, the third option is to unlock equity to leverage up your real estate token. And the way to do it, you take your real estate token, you collateralize it in one of the lending protocols, and out comes the USDC or Bitcoin or Ethereum, right? The liquidity strategy will be, and this is interesting. Well, we have integrated with Chainlink. If any of you is following our project last month, whereby we'll be bringing real-world valuation of the property on chain, updated on a regular basis. I'm looking at monthly basis, with valuation provided by respectable global valuers, the likes of your GIL, CBRE, Cushman & Wakefield, Savills, Knight Frank, and so on and so forth, right? And they will provide the based on this thing, a liquidation strategy could be developed, LTV could be formed, so that you could effectively start collateralizing real estate tokens on chain with all these primitives, like lending protocols. And something that we thought is even more interesting here. So let me just close on this topic about getting a mortgage on chain first. Imagine, right, today you go to a bank, right? Imagine you have a real estate that is paid out in full. You bought a property with cash, right, full cash, and now you have the property in full cash. Now, suddenly, you saw, let's say you realize over the weekend that, hey, there's this Irene DAO NFT that I'm going to aim into, right? I'm going to floor the entire NFT. I'm going to get all of them, right? Because I love Irene so much, for example. But the only way I'm going to get access to liquidity is my property, which is the only asset I have. Now imagine trying to call your banker 3 a.m. in the morning on a Sunday night, telling him that, hey, I need the cash instantly. I need the cash now because I want to go and ape into Irene DAO. It's probably going to tell you to just like get lost, right? That's not going to happen. And even if he entertained you, he will ask you that, sorry, dude, there's a process to follow. This is a whole bunch of application form. Please fill it in. Tomorrow on Monday, I'll do my best to get this expedited. And then if he gets expedited, you still have the whole bunch of questions that you fill out, like where are you from? What's your nationality? Uh, uh, where is the source of income? How much do you earn a month? Who are your employers? Who is your mom? Who is your dad? Who is your wife? Who is your son? Who is your grandmother? Whatever, right? How much other properties do you own? What other loans do you have? And you get the idea. The list goes on and on. But the question you ask yourself is, why do they need to know so much about you? They are going to get a piece of property that they're not going to give you at full value anyway. It's going to be an LTV of maybe 60-40%, or maybe 70-30%, or maybe even you're lucky 90-10%, right? There's a buffer there. The only thing they need is the property. Why do they have to know so much about you? What business is there for them to know all this about you? And let's say they know about all this about you. I can't imagine how ridiculous it is, right? Let's assume that they know all this about you already. The next step they go towards it, they will ask you saying that, okay, since I know all this about you, I like you, I'm going to lend you the money, right? You check out. So here's the LTV, okay? And again, it is them who set the LTV, but whatever, right? So they set LTV, say, okay, I'm going. Now, I have a whole bunch of valuation fees and legal fees, and you, who is borrowing the money from me, have to bear the cost of that. How reasonable is that? I'm not sure why people are willing to live with that, right? And then thereafter, the most ridiculous thing, even after you're willing to pay all this, they said, okay, dude, I'll give you the money, but please wait 30 days. Please wait 60 days or 90 days, right? If you're lucky, they like you, maybe 30 days. I know that's the fastest I can get a loan from a bank. If they don't like you, maybe the standard process is 90 days. I'm not sure, depending on where you're from, how much they like you. By then, by the time you get the cash in your hand, what use is there? All the NFT minted, everybody ate pin already. What's the point? Now imagine collateralized real estate tokens. No questions asked. You put in your real estate token, out comes the USDC. You go ape into whatever DAO you want. Mission accomplished. 5 minutes. That's the beauty about going bankless. That's the beauty of collateralized real estate tokens. That's what CitaDAO promises. And
Absolutely. Absolutely. Sorry to interrupt you there. That was a major breakdown, and I just want to agree that what you're describing here is incredible. The fact that your liquidity is available 24/7, and just like crypto never sleeps, this real estate will now never sleep. And one of the problems that I've personally seen with real estate is everything takes so long to get done, just from the initial getting it going, getting the surveys, getting the titles swapped over, just the chain of custody. All of those things take a long time, and once you get on chain, then your liquidity becomes available to access whenever you need it. So I just wanted to touch on a few of these points. That there are a lot of things to break down here, so I'm going to start with your three main focuses: accessibility, liquidity, and composability. So with accessibility, I know the point is to get access to everybody. Is there an entry point? Is there a sort of minimum entry for buying into these things, or will that be able to be set by each IRO? You're still muted, Joel.
Sorry about this.
No, that's okay.
I was talking to the wall, but sounding good. Anyway, we are a permissionless platform. We believe in accessibility. We believe that DeFi is built for everyone. It's built for the people, by the people. And therefore, the only limitation, I guess, the only limitations here is the fact that we built this on the Ethereum chain. So I will assume that you want to take into account gas fees if you want to decide on how much to put in, right? Because it wouldn't make sense to put in $10 and pay $50 in gas fees, right? Yeah.
Yeah,
So,
unless you think it's going to moonshot by 10,000%, then it's really not worth it. No.
Now, real estate is not going to happen that way. So I would guess that as a rule of time, probably 5 times to 10 times the gas fee. So if you are aping in when gas fees are low, then good for you, right? If you are aping in when gas fees are higher, then you need to adjust accordingly. But it's a permissionless platform. You connect your MetaMask and interact with the smart contract, and you decide how much you want to put in.
So you really could just invest $100 in this and pay the gas fees, and if price go up, then you're going to be making some money. Now, one of the questions which we've gone over before in our conversations, and I wanted to bring this up for everyone else to understand. Why did you choose Ethereum over an L2 or sidechain?
So the reason why we chose Ethereum over sidechains is because now I'm not sure how familiar you guys are with this one very unique peculiarity about Ethereum that may not be so apparent to pure DeFi projects. And that is most AML solutions that exist today in the world that we have today, they only operate on Bitcoin and Ethereum. So they do not operate on sidechains, right? And I mean, we are a legitimate project. We are not here to facilitate money launderers or hackers or whatever. We are here to increase accessibility, liquidity, and composability for real estate. So we take our responsibility seriously. We will be engaging AML solutions. It's non-intrusive. It's not going to interact directly on the front end. It's more on the back end where you will just kind of like identify potentially compromised wallets so that we don't allow those wallets to commit to the IO, for example. So that is one of the reasons why we build on Ethereum. Now there are also other more practical reasons. I mean, this is practical, but there are other more practical reasons such as higher liquidity on chain. I mean, Ethereum is a 500 billion platform. Some of the cheaper, some of the most affordable side chains, they are maximum like what 15 billion, 20 billion. And if you look at real estate as a class, that's effectively if you're taking on board like massive buildings, right? That's maybe at most 3 to 5 buildings. And then what next, right? Are you going to own the protocol, or can the protocol even scale as fast as the project, right? So that's the big question. Real estate is very bulky. Each building is tens, 20 millions of dollars. You could effectively fill out the entire market cap in a matter of months, and then what next, right? Then obviously the another reason is because of developer availability. It's still much easier to find developers for the Ethereum chain than other developers. I mean, we could look at we are also looking at EVM compatible chains for that reasons, but yeah, we have to address the other issue about TVLs, market cap, and the AML stuff, right? And then I guess one last reason, and I think is a very important reason to highlight also, is that most of the valuable, not talking about just NFT like projects, but valuable projects that have users for smart contract, like sorry, Aave, all this, they are actually built on the Ethereum chain. So to ensure that we have the maximum composability for real estate token, it only makes sense to build on the right chain, which is the Ethereum chain. So I hope that answers the question.
For sure. So total value locked, the robustness of the developer ecosystem, and offering true composability. So as far as composability goes, what are some of the things that you envision for anybody out there who's wondering what's composability? Essentially, you can just think of composability as money Legos. What can you build with these things? What's a value add? So what are some of the things that you envision for the composability aspects of the real estate moving forward?
One thing that I thought would be very exciting is the ability to mint stable coins with real estate tokens. Now you have stable coins backed by real estate, which may by itself be an inflation hedge. Imagine a stable coin that is an inflation hedge purely by itself, that goes in the opposite direction of the US dollar. I mean, if the US dollar is going down, right? And it's backed by real estate. I mean, yeah, I'm just trying to be realistic here, right? I mean, the more US dollar you print, the less value it has, right? So
no, I think we all understand that here, that, you know, the more you print, the less valuable it becomes. And with real estate, you can't really print more buildings. You got to build them, and you have to put the work in, proof of work, if you will. So ability to mint stable coins, that's an incredible idea right there. And so you could essentially have a stable coin which was pegged to the value of one particular building.
I mean, you could have stable coins that is pegged to a portfolio of real estate, right? Backed by real estate tokens. So effectively, the value of the real estate tokens will determine the value of how many stable coins you can print, right? And this idea actually came from a very interesting proposal that was submitted on Abracadabra Money by one of our community members. I'm not sure who, but the idea behind it being that we could actually, in fact, the solution is available already. Just pump the get real estate tokens accepted to mint new magic internet money, ironically, and then just mint the magic internet money, right?
Yeah, that does sound like magic. That's incredible. I hadn't even considered that. Are there any other things that pop to mind in terms of composability?
Yeah. So as mentioned, the idea behind reverse mortgage primitive lending protocols, unlocking capital from real estate by going to a very capital fused pool, for example, without having to go to a bank. I would love that, to be honest. And that will be very positive for the entire DeFi ecosystem also, I believe. In terms of composability, other things I could think about, actually a whole bunch of them. So another thing I could think about, futures and options primitive. So imagine today you are a landlord holding on to title deed in real life, and everything is booming, yay. You wake up tomorrow, the market crash, prices are falling through the roof. As a landlord, what do you, holding on title deed, and assuming you have a portfolio of maybe 10 properties under you, what do you do realistically? Two options. If you don't have a bank mortgage on the property, maybe you can hold on to it for dear life. If you have a bank mortgage, you might want to consider deleveraging, selling your real estate. And then you think about it, you're going to sell your real estate in real life, right? The first thing you do, you have to approach an agent. The agent will have to find a potential buyer, viewings and all, probably 30 days, 15 days, maybe if you're good, you find a good agent. And then you receive an offer, and maybe a lowball offer, but you take it anyway, right? Then after that, you take it, you pay a whole bunch of stamp duty, taxes, a whole bunch of government dues, legal fees, valuation fees, bank fees. The list goes on forever, right? And then collect your whatever meager profit you have left after that, and you hope to aid into the real estate space. You hope to opt into the real estate space when the market bottom, or you think the market has bottom, and then at the point in time you pay a whole bunch of stamp duty, government fees, lending fees, bank fees, whatever again, just to get in again. The game again is very inefficient. So that itself, the primitive, the CitaDAO project itself, allowing you to just instantly sell into AMM, into liquidity pool, and with you don't have to pay that kind of transaction cost that you pay in real life. That's already a winner. But let's look at you talk about composability. So let's talk about futures and options primitive, right? The other option, if let's say you were to hold on to it for dear life in real life, you pray like hell that the bank don't call you for mortgage for margin call if you have a mortgage on the property. And you hope that the next time the market peak again, the prices are higher than your current peak. But that's all you can do. Your options are very limited. But imagine with a futures option primitive, instantly you could either buy put options to hedge against your downside risk, make a profit as the market go down. You could sell call options. If you don't want to pay the premium for put options, you could sell call options to effectively increase the yield on your property. And interestingly, with all these kind of new primitives, new like derivatives options available, you might even have the long tail scenarios whereby people trying to short the real estate tokens outnumber the number of real estate tokens available to borrow. So people will end up buying the real estate tokens, and and you might end up into a short squeeze whereby the price of real estate in the real world might be falling, but because of demand supply on chain, the real estate tokens prices might be heading the opposite direction. So these are just some of the composability improvements I'm talking about. Obviously, you have others that you can think about, such as developers without land. Like, why do developers need to own their own land? How about developers that don't own their own land, but they collaborate with landowners who have real estate tokens so that they can scale up and share the profit with the real estate token holders? How about architect guild or professionals guild, whereby professionals come together, put out proposals to redevelop buildings to the real estate token holders. If it's accepted, the real estate token holders allow it to happen immediately. The building gets redeveloped and the profit gets shared with everybody who work on it, not your fat banks that sit around lending capital, not your shareholders who sit around doing nothing expecting profit. It gets shared between people who actually add value to the redevelopment.
Yeah, this is going to spark community. This is going to spark community-driven efforts. So this is going to increase community engagement within buildings, which I live near London, and one of the problems that I've seen in London is these giant buildings are constructed and people come in and invest in them, and then they sit empty because they're just investment properties. And the same thing happens in Manhattan and all these other big cities around the world. So if there were if there was more community involvement and more incentive to get involved as a community, maybe we wouldn't see these problems.
I was going to say it's very exciting, right? Just been listening in. From a participation perspective, it opens it up so much. I draw parallels to this effort to taking a step further. I mean, today we already have real estate investment trusts, right? We already have property investment syndicates, right? But we're on-chain, you have access to the on-chain capital. You can do even more securitization options with the token. However, these security type, trust type entities also have some sort of legal backing behind them, right? So for a DAO, it's great that you're going to have that governance. You're going to look at making a consortium decision on what to invest in and the yields and all that. My question is on it's looks like your first commercial property launch is a building in the UK, right? So from a legal structure perspective, what I see right now, it's a promise to the DAO that the underlying property will return the money to your IRO investors, right? But if you can speak a bit about your legal structures and how you plan to tie the real world to those tokens in terms of right of ownership, insurance if the property defaults. Like, are you essentially buying a guarantee of income from a property company that has to do all those legal things and pay the stamp duty and do all those anyway. Like, just to get an asset into the DAO, you have to interact with local regulations wherever you purchase, right? So you can talk about the tie between the two legal structures and what legal guarantees you have to investors who want to participate.
Okay, thanks for sharing that. And this is a very good topic. I believe many people are probably wanting to know more about it. So what we have done here, you have a right of claim against the underlying title deed. That's what the effectively a real estate token represent. No, wait, let's change that a little bit, okay? The real estate token represents the right to buy out all the real estate token holders. And the moment you buy out all the real estate token holder, you unlock a new right, which is that it gives you the NFT, and the NFT has the right to actually legally against the title deed of the property in law, at least in Commonwealth law. So that is what you're getting. In terms of how the transaction will be done, there's going to be a process whereby a brand new SPV will be set up. SPV will transact with the landlord. The title deed will be transferred from the landlord into the brand new SPV. And this is very important for any projects that don't do this. They say that, okay, we can buy out SPV that's set up by the property landlord, or maybe the property landlord has owned this SPV for ages. We just buy into the SPV. There is not a wise. In fact, in the even in the private equity real estate investment space I was in, we don't do this. We always start a fresh new company to buy out unless we are willing to spend tons of money doing due diligence on the existing SPV to make sure that there is no prior encumbrances or violation of law or whatever, which in some cases cannot even be detected by the lawyers, right? So the cleanest way is always to start a brand new SPV, transfer title deed, and during the transfer process, everything is wiped clean. You do not have to bear any of the liabilities that the previous landlord in his company might have incurred along the way. Yeah, so that's how the structure will take place. So the title deed will transfer to the brand new SPV. The SPV will issue the NFT. The NFT will get locked into a smart contract, and the smart contract will then issue a real estate token. Not sure that answers your question, but that's kind of the background behind it.
Yeah, I think the overview is great. I was trying to look in your website for more of the legal detail and all that. I understand, you're still starting to shape it. I think the more we can get of that content there, the more helpful it'll be. But thank you for that. I think it's a good overview.
The legal details we will not be sharing openly for good reasons. But
Yeah.
what we do have is executive summary or rather a legal opinion from law firms that basically validated the structure. So and we think that for practical reasons it makes more sense to if keen to share that because first not everybody is a lawyer. So reviewing the legal structure might require us to end up spending more time explaining everything to everybody, and that's time that we cannot afford at this point in time. And again, we are not lawyers, so we should not be the one explaining all these legal things. Our lawyers are not going to entertain everybody coming to them explaining the legal structure. So
for me, it's the legal structure helps to understand, but it's more the guarantee, right? That the SPV is somehow bonded to the ERC20 tokens, right? If that makes sense. Like the proof of that bonding and the reclaiming is what the redeemable against the deed is what you say, right?
The bonding structure.
Yeah.
Well, okay,
Right.
so the there's going to be a legal instrument that will be issued by the SPV together with the NFT. That legal instrument is the bonding mechanism.
Okay.
Yeah. So there's going to be a real world contract that will bond the token holders with the not only with the SPV but
Yep.
directly with the title deed of the property.
Okay, thank you.
Yes.
Thanks, I appreciate that. Thank you.
Nice. Thanks for your question, Windorch. I see Bennett has come up on stage as well. Did you have a question, Bennett?
Yes, thank you. My questions were actually
Bennett,
similar.
I think you're muted. You might want to unmute yourself.
Oh, can you hear me now?
I can hear you, but
talking.
sometimes this happens on the amphitheater and in the community calls. You might want to just disconnect, maybe restart Discord and pop back up.
Okay, cool. We'll be right back.
Yeah, we'll be here. Yeah, that was a great question from you, Windtorch. There's so much stuff to unpack here. I've created this massive list of questions for you, and so I'm just gonna touch on a couple more here. So, are there any real world blockers that you're running into? I know that you're focused right now on Commonwealth countries. How is the U.S. different from Commonwealth countries in their legal structure, and why are you not approaching the U.S. market, and do you see the U.S. market happening in the near future?
So, okay, this is a good question. First of all, there is two major system of law globally. One is called the Commonwealth law, the other is called civil law, and then you have many other laws in between, right? And the first reason why it's not possible under U.S. law is because the legal instrument that we will be issuing is not recognized. It's not even it's basically not recognized in U.S. That instrument doesn't exist in U.S. law. U.S. law is actually much more recent than English law. English law dates back to one of the oldest times. So they are obviously a lot more robust and a lot more comprehensive than U.S. law. So that's actually one the key reasons why a lot of other jurisdiction. I mean, even China, they have their own law, right? So that's really the reason why can't be. We actually combed literally multiple jurisdictions, studying all the legal structure before we arrive at consensus that Commonwealth law is the best for this reason. Yeah, the simple short answer, no. The one that we need to bond the legitimately bond the title deed and the SPV to the token holders. So in terms of whether it may be possible to do it in the US in the future, we have received many requests from this, to be honest, and because of that, what we have done, we have been engaging our lawyers, and one of the things that we thought is interesting that was put up is the idea of bridging via a Commonwealth country into the US, for example. So in the US time zone, there's Canada, which follows Commonwealth law. So for example, if the SPV holding on the title deed of the property is in a Commonwealth jurisdiction, we can still issue the legal instrument to bond the property to the token holders. And yeah, and because of that, it is potentially possible to also bridge into non-Commonwealth countries. It's just that at this point in time, we are at POC stage. We do not, we just want to prove the concept. We do not want to overcomplicate the process. So we will not be looking at non-Commonwealth country for now. But once we have gone through the POC, gone through the beta, and we have more resources on hand, definitely we will want to look into this bridging strategy of using Commonwealth country to bridge into non-Commonwealth real estate.
So that's some restrictions on bringing the IROs to the US. What about for US investors? Are there some securities issues with investing in these projects currently?
To be honest, at this point in time, I mean, I did say that we are not a security token and stuff, but to be honest, right now we don't have a clear definition of what the SEC determine is to be honest, we do not even know what SEC want to right now, right? Like they have not been.
Yeah, I don't think even the SEC knows what they're trying to do at the moment.
they have been contradicting themselves and slapping. It just looks very messy, to be honest. So for US investors, I would say that most projects will not be will basically have a disclaimer that US investors are not allowed. Likewise, we have that too. But I mean, it's DeFi, right? So DeFi is always DeFi, and despite despite this, you can still see DeFi US investors, at least those who know how to operate in a DeFi environment, kind of getting exposure in DeFi projects globally too. So I have no idea how they do it, but yeah, we are a DeFi project after all.
Okay, and this is not legal advice, so anybody in the States out there listening, DYOR.
Yeah.
So it looks like Bennett has disappeared from the stage. We've gone just over an hour, so I want to respect your time, but do you have time for a few more questions?
Definitely. Shoot away.
Okay, we did have a couple from the crowd beforehand. One of the more interesting ones that I saw was from Asturias, one of our contributors here, and she wants to know, will owners of the real estate be able to display other blockchain assets on the buildings? So is this, I suppose this might be a composability thing. She's thinking outside the box here. Do you have any thoughts about integrating the assets of the building possibly on the exterior of the building?
Now that's a question I like actually, so to start off first, right? The first POC building, the bank. I don't think HSBC is going to be happy to have you squatting in the corner in the bank, or camping out in their space, or maybe hanging a Bankless DAO flag outside the building. So I don't think for the first building you can do that, because it's a single tenant to a traditional financial institution. In fact, we thought the more interesting part about this is how for the first time we are getting a bank to pay rent to a DAO. Right? For the longest time, banks have been shutting down bank accounts, but I have no idea how they're going to stop paying rent to a DAO if the DAO is a legit owner of the building. So that's going to be quite interesting to see. But it's going to set history if that happens. So yeah, that's one. The second part, back to answering the question, the second IRO that we have is going to be a prime building in central London, located in Covent Garden, right down the road from the British Museum. I think that will be an interesting one. We are going to make that into a hacker house. We are going to make that into a building where the community can actually use, besides leasing it out to other tenants, right? So it could be an NFT gallery. You could have flags of different DAOs hanging out from the top of it. In fact, if I could share a picture of what it looks like, you'll see that it looks like a castle, literally. So it's called a sovereign house, by the way. So if any of you are Googling, so you could have flags hanging on the top of it. You have DAOs represented on top of it. You could have gatherings in that space. You could even build a mixed reality environment in the space, combining the virtual space and the real space, which we think is likely to be the future. You could have a co-working, co-living space. The community will have a whole lot of fun making use of the space. And we're thinking about it's going to be two-way. Either one, we allow real estate tokens to be staked to get utility access to space, or two, it will be leased out to a co-working DAO or co-living DAO that effectively accepts the real estate token as collateral to be staked to use the space. There are many ways we can build this, and this goes back again to the composability that you mentioned earlier. So very excited by that. We really hope that we can clear the first IO so we can get to that. Yeah, the first IO is the key, and we want to make a message. That's why we chose a bank building. It's literally the prime bank building in central Cardiff.
It's incredible that you've chosen a bank. So you touched on this briefly before, but essentially you're purchasing the building that currently houses the flagship HSBC bank in Cardiff, Wales. Cardiff is the capital of Wales, which is a country in the United Kingdom. For those who don't know what Wales is, there's always been some confusion there. As far as my American brethren go. So that's a huge undertaking in itself. And the bank is going to be paying homage to DeFi by paying rent to DeFi. So essentially, they're going to be helping you guys pay off the building by paying their own rent. To me, that's incredible. So when we say you're eating the bank's lunch, that is exactly what you're doing.
Yeah, the irony behind it.
So do you have a date for this? When is the IRO set to happen on that?
We originally planned for it to be in January, but the thing about it is that we realized that we have not had the opportunity to share the UI of our DApp with everyone yet. So right now we are going through a testnet phase whereby we'll be inviting the community to test the platform, to familiarize themselves with the platform, so that it's easier for them to interact with it when I mean, they're not going to see it for the first time, right? We're going to have instructional materials probably shown how to use it before. I mean, personally, I feel that it's very intuitive. It's literally a 3-stage process whereby you connect your wallet, you approve your commitment, and then you commit, and then you claim the tokens, right? But again, just want to be very careful about this. So we will be introducing the interface with the community before launching the IO proper. Again, we really want this to go through, because imagine the kind of statement we'll be making, buying out a bank. That is going to be something to look forward to. I mean, I'm going to look forward to that if it happens, right? And for all you know, maybe that might set a trend of buying out bank buildings. Or no idea, but that might potentially materialize.
I get the feeling that this is one that mainstream media is also going to skip over as well. We may not even see it in the news, but it's huge news. So I have a question from QStake that I wanted to. Oh, before I go on to that, I wanted to follow up with that. Was there a price set for this building already, and can you share that with us?
Yes, we are looking. The landlord in this case have communicated a price, and then with the transaction cost, everything worked into this, it's going to sum up to 20.69 million.
Okay, so you need to raise 20.69 million before those tokens get released, and if that total capital isn't raised, then people can claim their liquidity back.
Correct. But interestingly, in this case, because the landlord believe in this project and believe in this building, and they have actually gone through and with their own counsel and studied the structure in detail, they are willing to actually underwrite the property itself, which means that if we get about 60% of that 20.69 million, they will subscribe to the remaining 40% of tokens themselves.
And did we arrive on 20.69? Is that a mean number? Did they just pull that out of a hat?
you caught the 69. Yeah, we actually the landlord was actually thinking about a little bit of that, but we managed to convince him that 69 is a more beautiful number than his. I mean the landlord thinks that 88 is a lucky number, but we feel that 69 is a better number. So we kind of just advise the landlord to go with 69. Yeah.
Well, maybe your next building will be 420.69 million.
We should
So-
have 69 behind all our building prices, right?
Quite possibly, yeah. Make this into a proper meme project. I have a question from QStake, who hopefully is out in the crowd there. He asked this previously in the chat. So it's referring to how property managers are appointed. And it says in your documentation, the property manager who submitted the highest projected rent, lowest projected operating cost, and lowest property management fee will automatically be appointed by the DAO. So his question is, does this approach account for long-term property value protection? Would a low-cost, low-fee property manager be incentivized to allow an issue to persist to reduce short-term operating costs at the detriment of long-term value of the property? Is this going to encourage slumlords, apparently?
No, because there will always be a sinking fund. So major renovation efforts. I mean, you're obviously an experienced investor, real estate professional. If that's the kind of question you're asking, so there will be a sinking fund that will be set up as per any typical projects, real estate projects, to ensure that proper capital expenses are have the budget to be undertaken at key milestone along the property life.
Okay, and it mentions automatic appointment completed by code, or is that just a sort of turn of phrase when you say automatic appointment?
It's a turn of phrase. It can't be completed by code because we are talking about some of the more traditional property managers out there in the world today. We are talking about the global, the big ones, right? The GL, CBIs, all these of the world. So typically, they will need to they will need to sign a contract in real life. They can't sign a smart contract. But
Okay,
it's something we could potentially work towards. I mean, we have been engaging them in terms of their valuation services. So potentially along the way, we might, once we educate them and guide them into this space, they might be open to it.
Okay, so we've gone about 15 minutes over here. I do still have a bit of a list of questions here, but I do want to respect everybody else's time, and so we should probably wrap this up here. Is there anything else you wanted to add before we go here? We just had Composite Fella jump up on the stage. Would you like to ask a question, Composite Fella?
Yeah, I guess my main concern is it seems a lot like a mortgage-backed security, right? Everyone's buying a piece of the property and then that piece can be traded anywhere else. As you expand, how do you prevent it works out fine, like an SPV works out fine when the price of an asset is going up, but what happens when it goes down? Because there are lots of examples where that ended up terribly, right? Especially if you're going to build derivatives and things like that on top of it.
So okay, so first of all, let me just put it out first. The building, when it's acquired, will be 100% equity. There will be no other outstanding. So literally, we'll be buying out the banks and all the creditors and everything. So there will be no other debts in real life or any kind of creditors and everything except for
okay, I misunderstood that part.
Yeah. So because of that, I guess your question is in terms of the rent or in terms of the capital value?
Well, so my question is in your documents, I've been kind of scanning the website as you're talking, so sorry if I missed something, but the plan is to kind of create an asset that's tradable as an ERC20 token, and then that could be traded in other markets where maybe someone builds like a derivative on top of that. And this has happened multiple times in history, right? Like Enron used SPVs to provide assets to their stock, but when the stock went down, those SPVs collapsed. Or in 2008, the mortgage-backed security was kind of the same thing. It's like a chunk of a mortgage, right, that people sell. But if the value of the home decreases, then those decrease and everything that's been built on top of it also collapses. And so is there any kind of like thought to preventing things like that happening in the future, or are you guys considering any plan around things like that at all? It
Okay,
kind
so
of changes
first,
because you guys will own the whole asset.
yeah, okay, first thing first, right? The asset will be 100% equity, so that's understood. Secondly, right, the real estate tokens acts as the first layer of defense. So if ever there's going to be any crash, right, the crash will be, if the crash takes place on chain, I assuming you mean that the derivatives goes crazy and somehow it affected the price of the real estate tokens and the real estate tokens crash. That's fine, right? Because when the real estate tokens crash, what's going to happen is that people are going to redeem the real estate. If it falls below the real world value of the real estate, you could redeem the title deed and you still hold on to the real estate, which in real life is not going to move much, right? Unless there's a major economic crisis. And the third thing is we will not be allowing residential properties to be on chain from a sustainability perspective, at least not until we have a good idea how this will impact the prices of real estate in real life, because we are a socially responsible project. We want to bring DeFi to the community. We want to make life better for everyone. The last thing we want to do is to inflate the prices of houses globally and make it unaffordable for people to kind of own their own houses, right? So residential real estate is off limit for us for that reason. And so it will not flow down into the residential market per se. Most likely it will only flow down to the commercial real estate market, which has always been a lot more stable than residential market in this case. But then I'm just trying to understand your question, meaning that I'm hoping that I answered it correctly. Meaning that if let's say things fall apart on chain, whether the prices of real estate off chain is going to be affected. Am I right to say that? Is that your question?
Yeah, I think the problem is I don't necessarily have a specific question because this is the first time I'm looking over your stuff. It's a really interesting project and awesome work, by the way. I guess I just wanted to hear you kind of, if you had thought about these things, kind of where your guys' thoughts are, and it sounds like it's something you consider as you plan ahead. So I'm satisfied for now, and I'll probably just keep reading more.
Yeah, do feel free to ask any questions along the way. Yeah, I mean, there's two ways to interpret your question. The first one is on chain, right? If everything falls apart, right, whether it will affect the real world price. My answer to that is no, because it creates an arbitrage opportunity whereby people can actually aid into the real estate tokens and redeem the title deed in real life for a good arbitrage profit, right? Then the second part of looking at it is, let's say the real world property market crash big time, really lead to a collapse of the on-chain derivatives market. Again, the answer really depends on demand and supply when that happens. Because let's say, because the price of your property in real life is not going to move, even if everything is falling apart around you. Because ultimately what's going to happen here is that and for all you know, people might the community might want to borrow the real estate tokens or buy the real estate tokens to lend or something like that, and as a result, demand supply might end up the real estate tokens going the opposite direction from the actual market, or it might go in the same direction. But if it goes in the same direction, the fact that we believe in future the real estate token itself will be buffered by the use cases means that the use cases will generate sufficient demand such that it should not correlate one-to-one with the actual fall in prices in real life. And because of better liquidity, chances are it's probably not going to happen that way, right? Usually those market crash big times because it's a very illiquid market that receive a sudden huge shock, and everybody has no idea what the true value of the price is, and everybody was engaging in price discovery. People panic, people fart, and at the end of the day, it just bounced, right? So that is probably something that we could make better with the DeFi ecosystem that we're building here.
Thank you for that. Yeah, that I guess answers what I have for now. I'm sure I'll have plenty more, but Thinker included a link to your weekly AMA. So thank you very much.
Yeah, I've just posted a link to the Discord server. So if anybody's interested, go ahead and check out the CC Chatter channel and join the server. There's also some links to the CitaDAO website, so you can check out more information there.
I think talking about composability, Ethan do have a little bit of surprises for the BanklessDAO community also. Ethan, do you want to share some of those?
Yeah, I was just about to touch on that. So, Ethan, would you like to share your surprises with us?
Yes. So, great news. We are preparing for a community airdrop, and I think BanklessDAO being
Ethan, I think you're
great.
muted.
Oh, do you guys hear me? Hello, hello.
I do hear you. Can you not hear him, Joel?
No, I can't.
Okay. I will just reconnect. Okay, cool. I will continue then. So, yeah, we have an exciting airdrop that's coming up. So, and BanklessDAO being one of the partner community that we have, we will be giving everybody that holds Bankless token an airdrop. So, we will release more details pretty soon. I'll be taking a snapshot within the next 24 hours. Anyone who holds 10,000 bank token and above would qualify for the airdrop. And we'll release more posts by this Friday. There will be a website for you to check how much you're eligible to claim. There will be instruction on how to do it. It's fairly straightforward. Our dev is building it right now as we speak. Follow us on Twitter, and then you'll be able to read more announcement coming soon. So yeah, if you haven't got your bank token, go purchase some. And yeah, I'll be taking a snapshot within the next 24 hours. And those who are providing liquidity don't have to worry, because I'll include those in the snapshot as well.
So the balancer, people who have balancer tokens will also be included in that.
Yep.
Amazing. When is your token launch happening? Because your token, as far as I know, your governance token still hasn't launched, correct?
It's pretty soon. We are really excited, and then that's why we need a little bit more time internally, but we will let you guys know too.
Okay. This actually reminds me of one other question I had. Honestly, I have so many questions, and this is prescient to what we're just discussing now. So the CitaDAO token is going to be a governance token that involves engagement within your community and voting within your community. And then there will be separate tokens which are issued on a real estate basis. So for each different property, you're going to have your own set of tokens that are tied to that property. Am I viewing that correctly?
Absolutely right. So each individual building would have its own NFT, and each of the NFT would then be fractionalized to its ERC20 token. Joe, you have something to add?
Anything you wanted to add there, Joel?
I can't hear Ethan, but I guess if there's more questions about the token dynamics or how the CitaDAO token interact with the real estate tokens, you could come to our Discord channel and ask on the public channel. We'll answer you there. If you want a summary, it's very simple. We have basically converted real estate. So CitaDAO token is like the Bitcoin or Ethereum of real estate. And what we have done is that we have converted real estate tokens itself into sort of the solution to mine the CitaDAO token. So CitaDAO token is not sold. You can only get it on secondary market. It's not sold primarily by the project. And the only way to get it, if you're going to get it for free, is to LP. And the only way to LP is with the real estate tokens. So effectively, now real estate tokens, your real estate is literally converted into like your mining machines to mine for the CitaDAO tokens. Not sure if that makes sense, but we believe that this will make it a lot more interesting in the space, because traditionally you probably need like 25-30 years to recover your initial outlay for the real estate. But with this new design, you might be able to recover initial capital in 5 years or less, depending on the APY for liquidity pool, and the price action of the CitaDAO token.
Okay, I think that answers the majority of our questions that we've had today. So unless there's anything else you guys wanted to add, we can start wrapping this up. Anything else from you, Joel or Ethan? I'm going to take silence.
No,
as a no.
I'm good. So yeah, do join us on our Discord if you have any questions at all.
Is Ethan talking? I can't hear him.
Not yet. No, go ahead, Ethan.
Okay,
Right,
so basically,
you guys hear?
I'm very grateful for the BanklessDAO community to for this turnout here. I'm not sure it is a normal turnout, but it looks very encouraging. And the kind of questions asked, these are very good questions. These are very thought-provoking questions, and we do invite everyone to continue asking difficult questions, because that's how we can make this project a success together. We enjoy answering the most difficult and the most challenging kind of questions on our Discord. And members who have, or community members who have asked those questions have been rewarded with CitaDAO token, simply because to reward them for the time they spend understanding the project and for asking those questions. So please do come over. There's no questions that's outbound.
Yeah, you heard it, folks.
I look forward to meeting the BanklessDAO community and building this together with BanklessDAO to take out the banks.
Amazing. You heard it, folks. Get over there into the CitaDAO server and go give them some support and ask them tough questions. I know some of you have already just messaged me and said you've got a whole list of questions you're going to go over there and hit them up with. So this has been an amazing AMA, guys. You've come very well prepared. You've done your own due diligence, and it looks like this is a project that is really set to succeed. Before we go, I would like to give a shout out to both yourself, Joel, and Ian. Thank you very much for helping me host this and coming and providing our community with these opportunities. Thank you to NeoLogos for doing the recording on this. You really saved our bacon today, because I don't think Craig Bott was playing ball today. Thank you to Manuel Macau for setting this whole project up and getting the ball rolling with everything. And thank you to Brian Patino for saving the day on the POAPs. So the POAP claims have not actually arrived yet. I've been waiting for many hours for these POAP claims to arrive. But when they do, I will be uploading the claim links and everybody will be able to claim their POAPs. If you have not claimed a POAP before, or if you have not claimed a POAP within the last 2 weeks here in BanklessDAO, it's very simple. First thing you need to do is send a DM to DGen. I'm going to link DGen right now in the CC chatter. So click on DGen's name, say send message, and you're going to DM GM to DGen. GM for good morning. So go ahead and DM GM to DGen. After you've done that, you will be whitelisted per se in order to get your POAP claim link when that comes in. You can always check back tomorrow and use the POAP claim code or the claim command within the bots channel. So if you don't receive a DM from DGen within the next 24 hours, just go into bot commands /POAP claim, and that should work for you. Lastly, I would like to say we are not financial advisors. None of what we've said is financial advice. Investing in crypto and DeFi is risky. We're all excited about this project, but please do your own research. And on that note, I would like to just end this with Joel and Ethan. Thank you very much, and we will see you around the DAOs. Bye-bye, guys.